Question 1. An individual owns a personal disability income policy. Which of the following statements regarding the taxation of benefits received from this policy is most accurate? A. Benefits are taxable as ordinary income since premiums were paid with pre-tax dollars. B. Benefits are exempt from taxation as ordinary income because premiums were paid with after-tax dollars. C. Benefits are taxable only if they exceed a certain percentage of the insured's previous income. D. Premiums are tax-deductible, but benefits are fully taxable. Answer: B. Benefits are exempt from taxation as ordinary income because premiums were paid with after-tax dollars. Explanation: for an individual's personally owned disability income policy, the premiums are typically paid with after-tax dollars, meaning the individual has already paid income tax on the money used for premiums. Because the premiums are paid with after-tax dollars, any benefits received from the policy are generally not subject to income tax. This rule prevents double taxation, as the individual would otherwise be taxed on both the income used to pay premiums and the income received as benefits. Think of it this way: if you pay for it yourself with money that's already been taxed, the payout won't be taxed again. Question 2. Which statement accurately describes how Medicare Part C, Medicare Advantage plans, typically operate? A. Medicare Part C replaces original Medicare entirely and offers only limited benefits. B. Medicare Part C plans are generally offered by private insurance companies and are required to cover all original Medicare benefits. C. Enrollees must choose a Medicare Part C plan if they wish to receive prescription drug coverage, Part D. D. Medicare Part C is exclusively for individuals who qualify for both Medicare and Medicaid. Answer: B. Medicare Part C plans are generally offered by private insurance companies and are required to cover all original Medicare benefits. Explanation: Medicare Part C, also known as Medicare Advantage, offers an alternative way to receive Medicare benefits through private insurance companies. These plans combine Part A, hospital insurance, and Part B, medical insurance, and are mandated by law to provide at least the same benefits as original Medicare, often including additional perks like vision, hearing, or dental coverage, and most include prescription drug coverage, Part D. This structure allows beneficiaries to potentially consolidate their Medicare coverage through one private plan, offering convenience and potentially additional services. Remember, these plans are offered through Medicare but managed by private insurers. Question 3. Under a long-term care, LTC, insurance policy, which of the following is typically a common trigger for benefits to be paid? A. The insured being diagnosed with a chronic illness. B. The insured's inability to perform a specified number of activities of daily living, ADLs, without substantial assistance. C. The insured needing occasional assistance with household chores. D. The insured being hospitalized for more than 24 hours. Answer: B. The insured's inability to perform a specified number of activities of daily living, ADLs, without substantial assistance. Explanation: long-term care insurance policies are designed to cover the costs of assistance with daily living when someone can no longer perform certain basic self-care tasks independently. The most common trigger for benefits is the inability to perform a specific number, typically 2 or more, of the 6 activities of daily living, ADLs: bathing, dressing, eating, continence, toileting, and transferring, moving in or out of a bed, chair, or wheelchair. This functional inability, along with severe cognitive impairment, like Alzheimer's disease, are the primary ways to qualify for LTC benefits, ensuring coverage is activated when hands-on help is truly needed. Remember that ADLs are the key functional indicators for LTC claims. Question 4. An employee covered by a group health plan is terminated. Which federal law allows this employee and their dependents to continue their health coverage for a limited period? A. Health Insurance Portability and Accountability Act, HIPAA. B. Affordable Care Act, ACA. C. Consolidated Omnibus Budget Reconciliation Act, COBRA. D. Employee Retirement Income Security Act, ERISA. Answer: C. Consolidated Omnibus Budget Reconciliation Act, COBRA. Explanation: COBRA, the Consolidated Omnibus Budget Reconciliation Act, is a landmark federal law that provides former employees, retirees, spouses, and dependent children the right to temporary continuation of health coverage at group rates. This continuation is available when coverage is lost due to certain qualifying events, such as termination of employment, for reasons other than gross misconduct, or reduction in hours. It offers a crucial bridge, allowing individuals to maintain coverage while transitioning, though they typically pay the full premium plus an administrative fee. Think of COBRA as your safety net for continuing group health coverage after leaving a job. Question 5. Which characteristic is typically associated with a preferred provider organization, PPO, plan? A. Enrollees must choose a primary care physician, PCP, to serve as a gatekeeper. B. It offers the most restrictive choice of healthcare providers. C. Enrollees pay higher out-of-pocket costs for using out-of-network providers but still receive some coverage. D. Referrals are always required to see specialists, even within the network. Answer: C. Enrollees pay higher out-of-pocket costs for using out-of-network providers but still receive some coverage. Explanation: PPO plans offer flexibility by allowing enrollees to choose any healthcare provider, whether in-network or out-of-network, without needing a referral from a primary care physician. While using in-network providers results in lower out-of-pocket costs, like lower deductibles, copayments, or coinsurance, PPOs distinguish themselves by still providing some level of coverage for out-of-network services, albeit at a higher cost to the member. This balance of choice and cost-sharing makes PPOs popular for those who value flexibility. Remember, PPOs give you choices, but incentivize staying in-network. Question 6. A disability income policy includes an elimination period. What is the primary purpose of this provision? A. To prevent moral hazard by ensuring the insured has a legitimate disability. B. To reduce the policy's premium by requiring the insured to wait a certain period before benefits begin. C. To allow the insurer time to investigate the claim before making payments. D. To cover the initial costs of the disability not covered by the policy. Answer: B. To reduce the policy's premium by requiring the insured to wait a certain period before benefits begin. Explanation: The elimination period, also known as the waiting period, in a disability income policy is a specified number of days, starting from the onset of disability, during which no benefits are paid. Its main purpose is to reduce the overall cost of the policy by removing the insurer's liability for short-term disabilities. The longer the elimination period, the lower the premium, as the insured assumes more of the initial financial risk. Think of it like a deductible for time: you pay for the first part, the waiting period, yourself. Question 7. An insured intentionally misstates their age on a health insurance application. If this misstatement is discovered after the incontestability period, how will the insurer likely handle a claim? A. The insurer will deny the claim and refund all premiums paid. B. The insurer will void the policy as if it never existed. C. The insurer will adjust the benefits payable to what the premium would have purchased at the correct age. D. The insurer will pay the full benefits as stated in the policy, as the incontestability period has passed. Answer: C. The insurer will adjust the benefits payable to what the premium would have purchased at the correct age. Explanation: The incontestability clause generally states that after a policy has been in force for a certain period, usually 2 or 3 years, the insurer cannot deny a claim or void the policy due to misstatements in the application, except for misstatements of age or sex. For misstatements of age or sex, the standard provision allows the insurer to adjust the benefits payable to an amount that the premium paid would have purchased at the insured's correct age or sex. This ensures fairness to both parties without voiding the entire contract, allowing the policy to continue with corrected benefits. This specific rule for age/sex misstatement is a common exception to the general incontestability principle. Question 8. Under which circumstance are medical expenses generally tax-deductible for individuals? A. All medical expenses are fully deductible without limitation. B. Only medical expenses covered by insurance are deductible. C. Medical expenses that exceed a certain percentage of the taxpayer's adjusted gross income, AGI. D. Medical expenses are never deductible for individuals, only for businesses. Answer: C. Medical expenses that exceed a certain percentage of the taxpayer's adjusted gross income, AGI. Explanation: For individuals who itemize deductions on their tax returns, medical expenses are generally deductible only to the extent that they exceed a certain percentage of their adjusted gross income, AGI. This threshold is set by tax law and can change, e.g., 7.5% of AGI. This means that only significant medical costs that go beyond this threshold can be deducted, providing relief for those with very high healthcare expenditures not fully covered by insurance. Remember, this deduction isn't for everyone, only those with substantial out-of-pocket medical costs. Question 9. What is the primary purpose of a grace period in a health insurance policy? A. To allow the insurer additional time to process a premium payment. B. To give the insured a specified period to pay an overdue premium without the policy lapsing. C. To provide extended coverage for a specific period after the policy's expiration date. D. To allow the insured to change their mind and cancel the policy for a full refund. Answer: B. To give the insured a specified period to pay an overdue premium without the policy lapsing. Explanation: A grace period is a mandatory policy provision that provides a specific number of days, e.g., 7, 10, or 31 days, depending on premium payment mode, after the premium due date during which the policy remains in force, even if the premium hasn't been paid. Its primary purpose is to protect the insured from accidental lapse of coverage if they are a few days late with their payment. If the insured pays the premium during the grace period, the policy continues without interruption. If they don't, the policy will lapse retroactively to the original due date. This provision ensures you have a little leeway before your coverage is cancelled. Question 10. In health insurance underwriting, an individual with a history of frequent, minor accidents, even if they've never filed a major claim, might be considered a greater moral hazard. What does moral hazard in this context refer to? A. The risk of a loss occurring due to dishonest tendencies or carelessness of the insured. B. The physical characteristics of the insured that increase the likelihood of a loss. C. The increased probability of loss due to an insured's poor financial condition. D. The risk that an insured will cancel their policy shortly after issuance. Answer: A. The risk of a loss occurring due to dishonest tendencies or carelessness of the insured. Explanation: Moral hazard in insurance refers to the increased probability of a loss due to an insured's indifference to loss because they have insurance, or due to dishonest actions. In the context of the example, frequent minor accidents could indicate a lack of carefulness or an inclination to take risks, which the insurer views as increasing the likelihood of future claims. Underwriters assess this type of risk to ensure that potential policyholders aren't prone to creating or exacerbating losses simply because they are insured. It's about the attitude or character of the insured influencing the risk. Question 11. Which statement best describes a scheduled dental plan? A. It covers any dental procedure at 100% after a deductible. B. It pays a specified amount for each dental procedure, regardless of the actual cost. C. It bases payments on a usual, customary, and reasonable, UCR, fee schedule. D. It integrates dental benefits directly into a major medical policy with no separate limits. Answer: B. It pays a specified amount for each dental procedure, regardless of the actual cost. Explanation: A scheduled dental plan, also known as a basic or indemnity plan, provides a specific, predetermined dollar amount for each dental procedure listed in the policy's schedule of benefits. This means the plan pays a fixed amount, say $50 for a filling or $500 for a crown, regardless of what the dentist actually charges. If the dentist's fee is higher than the scheduled amount, the insured pays the difference. This differs from non-scheduled plans which pay a percentage of the usual, customary, and reasonable, UCR, charges. With a scheduled plan, you know exactly what the policy will pay for each procedure. Question 12. In an HMO, Health Maintenance Organization, plan, the concept of a gatekeeper primarily refers to a. The administrative staff responsible for approving all claims. b. The primary care physician, PCP, who manages the patient's care and controls access to specialists. c. The insurance company's representative who approves hospital admissions. d. The patient's responsibility to choose their own specialist without referral. Answer: B. The primary care physician, PCP, who manages the patient's care and controls access to specialists. Explanation: in an HMO, the primary care physician, PCP, acts as a gatekeeper, meaning they are the first point of contact for most medical needs and play a central role in managing the patient's overall healthcare. To see a specialist or receive other services, except in emergencies, the patient typically needs a referral from their PCP. This system is designed to control costs by coordinating care, preventing unnecessary specialist visits, and emphasizing preventive care through a single point of contact. The PCP helps ensure you get the right care at the right time. Question 13. To be eligible for a health savings account, HSA, an individual must be covered by which type of health plan? A. A preferred provider organization, PPO, plan. B. A health maintenance organization, HMO, plan. C. A high-deductible health plan, HDHP. D. Any managed care plan that offers preventive services. Answer: C. A high-deductible health plan, HDHP. Explanation: health savings accounts, HSAs, are tax-advantaged savings accounts that can be used for qualified medical expenses. A key eligibility requirement is that the individual must be enrolled in a high-deductible health plan, HDHP. The HDHP features a higher annual deductible than traditional plans, which helps to keep premiums lower, and the HSA serves as a complementary savings vehicle for meeting those higher deductibles and other medical costs. This pairing encourages consumers to be more mindful of their healthcare spending. Remember, HSA stands for Health Savings Account, and it always pairs with an HDHP. Question 14. An individual enrolled in Medicare Part B is generally responsible for what percentage of the Medicare-approved amount after meeting the annual deductible? A. 0%. B. 10%. C. 20%. D. 50%. Answer: C. 20%. Explanation: Medicare Part B, which covers medical services like doctor visits, outpatient care, and some preventive services, typically pays 80% of the Medicare-approved amount for most covered services after the beneficiary meets their annual deductible. This means the individual is responsible for the remaining 20% coinsurance. This 20% is a significant out-of-pocket expense, which is why many Medicare beneficiaries choose to purchase Medigap policies or enroll in Medicare Advantage plans to help cover these costs. Always remember that 20% is the standard beneficiary share for Part B. Question 15. Which characteristic is typically associated with eligibility for Medicaid benefits? A. Being 65 years or older and receiving Social Security benefits. B. Having previously served in the U.S. military. C. Meeting specific low-income and resource requirements established by federal and state law. D. Paying an annual premium based on income and family size. Answer: C. Meeting specific low-income and resource requirements established by federal and state law. Explanation: Medicaid is a joint federal and state program that provides health coverage to millions of Americans, including eligible low-income adults, children, pregnant women, elderly adults, and people with disabilities. Unlike Medicare, which is primarily age-based, Medicaid eligibility is determined primarily by an individual's income and assets, resources, which must fall below certain poverty thresholds established by both federal guidelines and individual state regulations. It's a needs-based program designed to ensure healthcare access for those with limited financial means. Question 16. A disability income policy includes a recurrent disability provision. What is the main purpose of this provision? A. To provide benefits for a second disability that occurs after recovery from a prior, unrelated disability. B. To extend the elimination period for each new instance of disability. C. To prevent the insured from having to satisfy a new elimination period for the same or a related disability. D. To allow the insurer to reduce benefits for recurring disabilities. Answer: C. To prevent the insured from having to satisfy a new elimination period for the same or a related disability. Explanation: A recurrent disability provision is designed to protect the insured if they experience a relapse of the same disability, or a disability arising from the same cause, within a specified period, e.g., 3 to 6 months, after returning to work. If the disability recurs within this period, it is considered a continuation of the original disability, meaning the insured does not have to satisfy a new elimination period. This ensures that a policyholder isn't penalized for a temporary return to work if their condition quickly re-emerges. This provision offers peace of mind by preventing multiple waiting periods for the same health issue. Question 17. An individual purchasing a long-term care (LTC) policy wants to ensure their benefits keep pace with rising healthcare costs. Which optional benefit should they consider adding? A. Return of premium rider. B. Non-forfeiture benefit. C. Inflation protection rider. D. Waiver of premium rider. Answer: C. Inflation protection rider. Explanation: The inflation protection rider, also known as the automatic increase benefit, is a crucial optional benefit for long-term care policies designed to combat the rising costs of care over time. This rider automatically increases the daily benefit amount and/or the maximum policy benefit at a predetermined rate, e.g., 3% or 5% compounded annually, without requiring additional proof of insurability. Since long-term care costs can significantly increase over decades, this rider helps ensure that the policy's benefits remain adequate years down the line. It's vital to protect your future purchasing power against rising healthcare expenses. Question 18. A waiver of premium rider is often added to various types of insurance policies, including health insurance. What does this rider typically provide? A. It waives the policy's deductible if the insured is hospitalized. B. It exempts the insured from paying premiums if they become totally disabled. C. It allows the insured to pay premiums less frequently without penalty. D. It waives the need for medical underwriting if the insured's health declines. Answer: B. It exempts the insured from paying premiums if they become totally disabled. Explanation: The waiver of premium rider is a valuable feature that, if triggered, exempts the insured from paying policy premiums while they are totally disabled. This means that if the insured becomes severely ill or injured and cannot work, the policy remains in force without the need for further premium payments for the duration of the disability. This rider provides significant financial relief during a period of reduced income, ensuring that essential coverage continues when it's needed most. It's a safeguard that keeps your policy active even when you can't work. Question 19. Which aspect of the Health Insurance Portability and Accountability Act, HIPAA, primarily addresses the ability of an individual to transfer from one health insurance plan to another without a lapse in coverage due to pre-existing conditions? A. Privacy rule. B. Security rule. C. Portability. D. Uniformity of benefits. Answer: C. Portability. Explanation: HIPAA, the Health Insurance Portability and Accountability Act, includes provisions designed to improve the portability of health insurance coverage. The portability component of HIPAA helps individuals who change jobs or lose coverage maintain continuous health coverage by limiting the ability of new group health plans to exclude coverage for pre-existing conditions, provided the individual had continuous prior creditable coverage. This was a significant step toward ensuring that people weren't locked into jobs solely because of their health insurance. HIPAA's portability rules smooth transitions between group health plans. Question 20. Basic medical expense policies are often characterized by first dollar coverage. What does this term mean? A. The policy pays for 100% of all medical expenses from the very first dollar. B. The policy pays benefits immediately for covered expenses without requiring a deductible to be met. C. The policy only covers the first dollar of expensive medical treatments. D. The policy covers only basic, routine medical expenses and nothing else. Answer: B. The policy pays benefits immediately for covered expenses without requiring a deductible to be met. Explanation: First dollar coverage is a characteristic of some traditional basic medical expense policies, meaning that the policy begins to pay for covered medical expenses as soon as they are incurred, without the insured first having to meet a deductible. This differs from major medical policies, which almost always require a deductible to be satisfied before benefits are paid. While basic policies typically have lower maximum benefits and cover specific types of services, like hospital, surgical, or physician visits, the advantage is that the insurer starts paying from the very first dollar of covered expenses. Question 21. According to the Uniform Individual Accident and Sickness Policy Provisions Law, after how long may legal action be brought against an insurer regarding a claim? A. Immediately after the claim is denied. B. No sooner than 60 days after furnishing written proof of loss. C. No later than 1 year after the date of loss. D. Within 30 days of the insurer's final decision on the claim. Answer: B. No sooner than 60 days after furnishing written proof of loss. Explanation: The legal actions mandatory provision in individual health insurance policies specifies when an insured can take legal action against the insurer for a claim. It typically states that no legal action can be brought against the insurer less than 60 days after the insured has furnished written proof of loss. This waiting period allows the insurance company adequate time to investigate the claim and make a determination before a lawsuit can be filed. The provision also specifies an outside limit, usually 3 years, within which an action must be brought. This 60-day waiting period gives the insurer a chance to resolve the claim internally. Question 22. To qualify for Social Security disability benefits, an individual must meet a very strict definition of disability. What is this definition based on? A. Inability to perform their own occupation for a specified period. B. Inability to engage in any gainful activity due to a medically determinable physical or mental impairment that is expected to last at least 12 months or result in death. C. Inability to perform at least 2 activities of daily living, ADLs, without assistance. D. Being hospitalized for more than 90 consecutive days. Answer: B. Inability to engage in any gainful activity due to a medically determinable physical or mental impairment that is expected to last at least 12 months or result in death. Explanation: Social Security's definition of disability is one of the strictest, designed to provide benefits only for severe, long-term disabilities. An individual must be unable to engage in any substantial gainful activity, SGA, due to a medically determinable physical or mental impairment. This impairment must be expected to last for a continuous period of at least 12 months or result in death. It's not enough to be unable to perform your own job, you must be unable to do any job for which you are qualified. This stringent requirement ensures benefits are reserved for those truly unable to work. Question 23. Under a group health insurance plan, what is the significance of an enrollment period for new employees? A. It is the period after hire during which an employee must pay an initial premium to qualify for coverage. B. It is the timeframe during which new employees can join the group plan without proving insurability. C. It is the annual period when all employees can make changes to their benefit elections. D. It refers to the waiting period before an employee's coverage actually begins. Answer: B. It is the timeframe during which new employees can join the group plan without proving insurability. Explanation: For group health insurance, an enrollment period, often called a probationary or waiting period followed by an open enrollment window for new hires, is a specific timeframe, typically shortly after a new employee becomes eligible, during which they can enroll in the group health plan without having to provide evidence of insurability. This means they are guaranteed coverage regardless of their health status, which is a major advantage of group insurance. If an employee waits to enroll until after this period, they may need to go through medical underwriting or wait until the next annual open enrollment. This guaranteed enrollment is a cornerstone of group benefits. Question 24. Which type of policy provides coverage for a specific group of people whose composition changes frequently, such as students at a school or passengers on a bus? A. Group major medical policy. B. Blanket health policy. C. Franchise health policy. D. Association group policy. Answer: B. Blanket health policy. Explanation: A blanket health policy is specifically designed to cover a group of individuals whose membership changes frequently and for whom individual identification is not practical or desirable. Common examples include students participating in school activities, campers at a summer camp, or passengers on a common carrier like an airline or bus. These policies provide coverage for accidents or illnesses that occur during the specified activity or period, without needing to list each individual insured. Think of it as coverage that blankets an ever-changing group. Question 25. Which type of managed care plan combines features of both HMOs and PPOs, allowing members to choose a primary care physician, PCP, for in-network care or opt for out-of-network care at a higher cost? A. Exclusive Provider Organization, EPO. B. Health Maintenance Organization, HMO. C. Preferred Provider Organization, PPO. D. Point of Service, POS, plan. Answer: D. Point of Service, POS, plan. Explanation: A point of service, POS, plan is a type of managed care plan that offers a hybrid approach, combining characteristics of both HMOs and PPOs. Like an HMO, a POS plan typically requires members to choose a primary care physician, PCP, within the network to manage their care and provide referrals for specialists, offering lower costs for in-network services. However, similar to a PPO, members also have the option to seek care from out-of-network providers, although this will result in higher out-of-pocket costs, such as higher deductibles and coinsurance. This structure offers flexibility while still promoting coordinated care. It's the best of both worlds for those who want both network benefits and out-of-network options.